How can you avoid false signals in commodity technical analysis? Imagine trying to catch a train that might not be coming. That's what false signals in commodity technical analysis can feel like. They can lead you to make poor investment choices if you're not careful. So, how do you tell the real signals from the fake ones? Well, it all comes down to smart strategies and good analysis techniques. First, remember that no single technical indicator is perfect. Each one has its flaws and can produce false signals because of market noise or sudden price jumps. Relying on just one indicator is like trusting a single piece of advice. It's better to use multiple indicators that measure different things. For example, combine moving averages with momentum tools like the Relative Strength Index or the Commodity Channel Index. If both show the same signal, it's more likely to be accurate. Next, think about the time frame you are analyzing. Short-term charts often have more noise, which can lead to false signals. Using longer time frames like daily or weekly charts smooths out the bumps and gives clearer trend signals. For instance, a break above a long-term moving average on a weekly chart is more meaningful than a quick crossover on a 5-minute chart. Adjust your indicator settings carefully. Short-term moving averages tend to generate many crossovers, which can be false signals. Using slightly longer periods helps filter out minor price swings. Similarly, setting proper thresholds on oscillators like the RSI or the CCI prevents you from acting on premature signals. Volume is another key factor. When prices move sharply, check if volume supports the move. A breakout with high volume is more trustworthy than one with low volume. Watch for divergences too. If the price hits a new high but the momentum indicator doesn't, it could warn you of a potential reversal or false breakout. Envelopes and bands, like Bollinger Bands, also help. When prices stretch beyond these bands, it might signal an overbought or oversold condition, hinting at a possible reversal rather than a trend continuation. It's important to distinguish between actual signals and mere anticipations. Confirmed breaks of moving averages or other clear signals are more reliable than guesses about how long a trend will last. Combining technical signals with fundamental news is also wise. Unexpected events like supply disruptions or geopolitical issues can change the market quickly, invalidating technical signals. For example, a commodity might break a resistance level, but if there's news of a sudden supply cut, the move could be false or short-lived. To put it simply, wait for confirmation. For example, before entering a long position, look for the price to break above a long-term moving average, supported by rising volume and a positive momentum indicator. Avoid acting on a single short-term crossover or an isolated RSI reading. By using multiple indicators, choosing the right time frames, confirming signals with volume and momentum, and staying aware of news, you can cut down on false signals. This way, your trading decisions will be more solid and less likely to lead you astray.